It starts with a conscious decision as to what you want to accomplish. Now, this may sound easy. Well, we want to have more money rather than less. We want to have a higher return rather than less. But the starting question for any organization in investing should be, will we settle for average, or do we want to try to be above average? Now, that sounds like an easy one. But you have to recognize that in investing, it's extremely easy to be average. You can buy off-the-shelf products that will guarantee you that you'll do average. Or you can try to be above average, which is extremely difficult. And there is no surefire solution to how to get there. And if you try to be above average, it exposes you to the risk of being below average. The two are inseparable. So thoughtfully, consciously, intentionally, which is it for you and your organization? Next question is, how will you and your organization think about risk? What is risk? In all the formula mathematical work in the investment business, people use variability of results as the measure of risk. I don't think that's the real risk. I think the real risk is the risk of bad outcomes. But the trouble with my form of risk is it's not measurable. You can't measure what the probability of bad outcomes is in the future. You can't even measure what the probability of bad outcomes was in the past. You can only measure what happened, which is a subset of what could have happened. On the last slide, I had a quote from Elroy Dimpson, who was a professor at the London Business School. He said, "Risk means more things can happen than will happen." The conventional view of risk is shown in this graphic here. You have return on the vertical axis, risk on the horizontal axis, and a line that slopes up and to the right. And mathematicians call this positive correlation. If one goes up, the other goes up. Most practitioners take this to mean that riskier assets have higher returns. There's something wrong with that formulation. If riskier assets could be counted on to have higher returns, by definition, they wouldn't be risky. So the way I look at it is more like this. I take these little bell-shaped curves, I superimpose them on the same line. It's the same underlying line. But now, as you move from left to right, not only does the expected return increase, but the range of possible outcomes gets wider, and the bad outcomes become worse. That, I think, is risk. That is what people should concern themselves, not the possibility that their return streams will be lumpy. Buffett said, "I'd rather have a lumpy 15 than a smooth 12." And I think that makes a lot of sense.